So this week we were looking at monetary and fiscal policy. What I wanted to do was spend a little bit more time looking at the role that the Federal Reserve plays in our fractional reserve banking system. So we know that according to the notes, that the Federal Reserve was created in 1913 by an act of Congress and is going to be comprised of the 12 central banks that serve as banks and other financial institutions within each of the Federal Reserve districts. So what I wanted to do was specifically look at the Federal Reserve system, which is just commonly referred to as the Fed. Now let's start with looking at some of the primary responsibilities of the Fed. Now, as we highlight these primary responsibilities, we're going to see that there's going to be a tool that the Fed can use to target each of these responsibilities. So the first one is going to be monetary policy. So we know that the Fed controls the U.S. money supply. So the Fed controls the U.S. money supply. And they're going to be charged with regulating it. And they're charged with regulating it. So they're charged with regulating it to try to offset any macroeconomic fluctuations. So to offset some of those macroeconomic fluctuations. Now, the second primary responsibility of the Fed is going to be central banking. So we're going to see that the Fed serves as a bank for banks, essentially. So they're going to serve as a bank for banks in the sense that they hold their deposits and also extends loans to them. And then the third primary responsibility is going to be bank regulation. So they're going to be one of the primary entities that are charged with ensuring the financial stability of banks. So charged with ensuring the financial stability. Of banks. Now this is going to include, this includes setting the reserve requirements. So it includes the determination of the reserve requirements. So if you remember from last week, we know that banks are required to keep a certain amount on hand. So the Fed is the one who is in charge of determining that reserve requirements, whether it's 10% or 5% or 15%. Now, those are going to be the three primary responsibilities. Very briefly, let me just touch on the organization of the Fed. So I can make some distinctions that I probably didn't touch on as specifically in the notes. Now, first and foremost, the Fed is independent of the federal government. So Congress oversees the Fed, but they do not interfere with the decisions made. Now, if the Fed implemented policies that were not in the best interest of the nation, then of course the Fed could be abolished. But as I mentioned, moving forward, The Federal Reserve consists of, we said, 12 districts, 12 districts, and 24 branches. Now, the group that oversees the districts is the Board of Governors. So, the Board of Governors. Now, the Board of Governors consists of 7 members appointed by the President and confirmed by the Senate to serve one renewable 14-year term. So 7 members who serve a non-renewable 14-year term. Now, these are going to be the main governing body of the Federal Reserve System. So they're going to be charged with overseeing the Federal Reserve banks and with helping to implement monetary policy in the United States. So they're going to be the ones who, once again, supervise and control the money supply and the banking system of the U.S. Now, the question that I always throw out to my students is, why do you think there's a 14-year term for these members of the Board of Governors? Now, the reason why is to kind of protect from any short-term politics, and it helps to ensure that the individuals are more comfortable to make decisions that they feel are in the best interest of the economy. And they're also staggered so that the president can't choose all members to support their party's interests. So the president chooses 2 per term. Now, the president also selects a chairman to serve a 4-year term. Now, currently, Jerome Powell is the chairman. So the current chairman of the Board of Governors. So he was sworn in on February 5th, 2018. So he was nominated to the position by President Trump and later once again confirmed by the U.S. Senate. So the Board of Governors is once again very independent. So I can't stress that enough. So the Board of Governors is independent and once again does not take orders from the president or any other politician. Now, the reason why they're able to be very independent is because they're also self-supporting. So the Fed earns interest on government securities, and actually let me write that out so because that's also very important to know. So the Fed is self-supporting. Now, when I say that they're self-supporting, that's because they once again earn interest on government securities. So on government securities issued by the Treasury and loans that have been made. So in loans that they've made. So once again, they don't rely on other government agencies in order to run smoothly. Now, the Fed has about $4.5 trillion in assets, and the majority of the revenue comes from these open market operations that we're getting ready to talk about. Specifically, the interest on the Fed's portfolio of Treasury securities, as well as money that comes in from buying, selling securities, their derivatives, fees received from price services provided to other depository institutions, clearing checks, funds transfers. There's a number of things that allow the Fed to be self-supporting. Now, speaking of these government securities, another portion of the Fed is going to be the Federal Open Markets Committee. The Federal Open Market Committee. Now, these are going to be the individuals that directs the buying and selling. So they direct the buying and selling of U.S. government securities. So what's really important about this committee is that they're going to increase the money supply. So they will increase the money supply if there is unemployment, and then they'll decrease the money supply if there is inflation. So they will decrease the money supply if there is inflation. Now, buying and selling these government securities are going to be major instruments, once again, for controlling the money supply. So with this Federal Open Markets Committee, if there's high unemployment, they're going to try to increase the money supply to get spending up. If there's high inflation, they're going to try to take money out of the economy so that it can cool down. So we'll come back to this, but this is probably going to be one of the most important concepts that we'll talk about this chapter. So we have the Federal Open Markets Committee. Now that we kind of looked at some of the levels of the Fed, let's jump back into some of their responsibilities that they have. Now, as I mentioned, the Fed is the central bank, which means that they serve as a bank for banks. So in its role as a central bank, it offers support and stability to the nation's entire banking system. Now, the first component of this role involves the deposits that banks hold at the Fed. So recall that banks are required to keep a percentage of checkable deposits in either vault cash or on reserve at the Fed. These are what we call federal funds. So federal funds. Now, federal funds are going to be the deposits that private banks hold on reserve at the Fed. So at the Federal Reserve Bank. So once again, deposits that private banks hold on reserve at the Federal Reserve. Now, the word federal seems to denote that these are government funds, but in fact, they're just private funds held on deposit at a federal agency, which is the Fed. So banks keep reserves at the Fed also in part because the Fed clears loans between them and other banks. So when banks loan reserves to other banks, these are what we call federal fund loans. So we have federal funds, and then we can have federal funds loans. Once again, these are going to be loans from a bank's reserves to other banks. Now, these are typically going to be very short-term loans, so a lot of times they're just overnight loans. And they allow banks to make quick adjustments to their balance sheets. So always throw out the question, why would banks need to take a short overnight loan? So sometimes a bank might dip below its required reserve level and it can approach another bank for a short-term loan. If that bank happens to have excess reserves, making the short-term loan enables it to earn interest. So the interest rate on such interbank loans is also known as the federal funds rate. So with these loans, of course, they're not loaned out without any interest. So the interest that's charged is what we call the federal funds rate. So that is going to be the interest on loans between private banks. All right. So once again, the since the Fed is a bank for banks, let's look at the relationship and see how the relationship between the Fed and commercial banks is kind of analogous to the relationship between banks and households and firms. So last week we looked at the relationship between households and firms and commercial banks. Now, first we know that households and firms hold deposits at banks. So they hold their deposits at banks. So that's your checking account. Once again, firms have their business accounts at commercial banks. And then also, as we add in the Federal Reserve here, we know that the banks hold their deposits at the Federal Reserve. Now, if you recall, these are what we call those federal funds. Now, secondly, we know that households and firms take out loans from banks, and banks can take out loans from the Fed. So we said that households and firms receive banks or loans from banks. In the same way that households and firms can receive loans from commercial banks can also receive loans from the Fed. Now, these loans are what we call discount loans. So discount loans are going to be loans from the Federal Reserve, once again, to private banks. So loans from the Federal Reserve to private banks. Now, these discount loans are the vehicle by which the Fed performs its role as like the lender of last resort. So, given the macroeconomic danger of bank failure, the Fed serves as an important role as a backup lender to private banks that might find difficulty borrowing from other places. So, just like with any loan, the Fed is going to charge interest on these loans. This is what we call the discount rate. The discount rate, once again, just by definition, is just going to be the interest rate on discount loans. So on discount loans made by the Fed. Now, discount loans don't happen too often, but in extremely turbulent times, they are there to kind of reassure financial market participants such as these commercial banks. Now, the Fed also serves as a regulator of individual banks. Now, in this role, the Fed this includes, I guess, the setting and monitoring of those reserve requirements as we talked about earlier. So I'll just say the Fed as a regulator of individual banks. So once again, this just includes setting and also monitoring reserve requirements. And also, they monitor balance sheets of banks. So monitoring the balance sheets of banks. with an eye towards kind of limiting the riskiness of assets that banks hold. So the question that I always throw out is, why do you think banks are subject to this kind of regulation? And the reason why is because due to the interdependency, I guess, nature of banking firms, problems often spread throughout the entire industry very quickly. Now, also because of deposit insurance, banks and their customers have reduced incentives to monitor the riskiness of the assets. So that's another moral hazard. But going back to our primary responsibilities for the Fed, first off, once again, it's monetary policy. Second, central banking. And then third, bank regulations. So knowing that, let's look at the tools of the Fed. So let's look at some of the tools of the Fed. Now, the Fed can use their tools to do one of two things. They can try to increase the money supply. So that's going to be your expansionary monetary policy. Or they can try to decrease the money supply. So that's going to be contractionary. So let's look at the three different tools that they have. So tools of the Fed, and then we're going to add them in to look at what they're going to do in each case to either increase the money supply or to decrease the money supply. So let's start with this first one. The first one is what we call open market operations. Open market operations, which is often abbreviated as OMO. The second tool that they have is discount lending. And then the third tool is the required reserve ratio. So let's start with this first one, open market operations. Now, these open market operations are going to refer to the buying and selling of government securities and the open market in order to expand or contract the monetary or contract the amount of money that's actually in the banking system. So it refers to the buying and selling of government securities. Now, as I mentioned earlier, the Fed has a very extensive portfolio of government securities that include treasury bonds, bills, and notes. So once again, that's right around $4.5 trillion. So when the Fed wants to increase the money supply, so when the Fed wants to increase the money supply, it buys securities. And then when the Fed wants to decrease the money supply, it's going to sell securities. So by doing this, the Fed is trying to get funds directly into the market for loanable funds and take funds directly out of the market. Now, typically, a day's worth of open market operations might entail as much as $20 billion worth of purchases from the Fed, and the market for the U.S. Treasuries is going to be big enough to accommodate this level of purchases seamlessly. Now, the daily volume of the U.S. Treasury market is over $500 billion, so the Fed can buy and sell without any difficulties. So let's look at the impact of one of these open market operations and see how it actually works. Now, both individuals can hold government bonds and also banks can hold government bonds. Now, those bonds are going to be like your savings bonds, which offer like a fixed interest rate over a certain period of time. Now, when an investor buys and holds a savings bond until its maturity, they receive the bond's face value plus whatever that accrued interest in. Now, we also have like these treasury notes. They're often called like T notes. They're like intermediate term bonds, and they mature in 2, 3, 5, or sometimes even 10 years. And then we have our treasury bonds, which are going to be your long term bonds maturing in about 10 to 30 years. So the Fed buys these government securities through security dealers in the bond market. And oftentimes we'll see that if a bank has extra reserves but is not ready to kind of lock in for a loan for the long term, they can invest in some of these securities to earn interest. Now, when the Fed purchases these securities, they aren't going to send you cash in the mail. What they're going to typically do is credit your checking account. Now, we know that when the Fed purchases these securities and it goes into your checking account, according to what we looked at last week in the banking chapter, we know that that's going to cause our excess reserves to increase. So let's look at this first scenario. When the Fed buys government securities, that's going to lead to an increase in checkable deposits. So once again, if the Fed buys some of my government securities, they're not going to send me that cash in the mail. They're going to deposit that money directly into my checking account. So we know that when checkable deposits go up, that's going to lead to an increase in excess reserves for banks. Now, as excess reserves go up, that's going to lead to an increase in loans that banks can issue. And we know that when loans are issued, that is when we see the money supply increasing. So whenever the Fed buys these government securities, they're getting more money into the economy. So that's going to be our expansionary policy. So purchasing government securities is going to be one of the tools. In order to increase the money supply. Now, conversely, we'll see that when the Fed sells securities, that's going to cause money to come out. So that's what we call this contractionary monetary policy. Now, when the Fed sells these government securities, so if I'm purchasing some of the Fed's government securities, once again, I'm not sending them cash. I'm going to probably enter in my bank routing information, or routing number and account information, and that money is going to be deducted from my checking account. So that's going to lead to a decrease in checkable deposits. Now, we know that when checkable deposits go down, that's going to lead to a decrease in excess reserves that the bank has to hold on to. Now, when excess reserves are going to go down, that leads to a decrease in the amount of loans that the banks can issue, which in turn can lead to the money supply decreasing. So this is once again contractionary monetary policy. So the Fed can choose to sell government securities. Now, this is going to be, once again, these open market operations, the easiest, most effective, and are used 99% of the time for the Fed to try to control the money supply. Now, they do have those two other tools, but neither of these have been used recently for monetary policy, but they are available. Now, if you recall, the Fed sets the ratio of deposits that banks must hold on reserve. That's going to be our required reserve ratio. So if we find our required reserve ratio, let's say it's 10%. So if our required reserve ratio is 10%, which means that banks must have on hand at least 10% of their checkable deposits, our money multiplier is going to be equal to 1 over that required reserve ratio, which is 0.1. So our money multiplier is going to be 10. Now, what do you think happens if the required reserve ratio it goes up to 20%? Now, as we find our new money multiplier, be 1 over 0.2, which is going to be equal to 5. So we see that if the required reserve ratio is increased, it reduces the impact of an initial deposit on the overall money supply. Now, if banks are required to hold more on deposit, that means less money that they have in excess reserves to loan out. So what we will see is that if the Fed increases the required reserve ratio, that's going to lead to a decrease in excess reserves as the banks are required to hold on to more money. Now, with less money that they have in excess reserves, that's also going to lead to a lower amount of loans that they're able to issue. And as loans decrease, the money supply decreases. So another form of contractionary monetary policy. So that will just be increasing the required reserve ratio. Now, if the Fed were to decrease the required reserve ratio, telling banks that they don't have to hold as much money in required reserves, that's going to lead to more money that's available to be held in excess reserves. And we know that when excess reserves go up, that's going to lead to an increase in the amount of loans that they're able to issue. And as loans are going up, that's going to lead to our money supply increasing. All right, so that's another tool for expansionary monetary policy. Now, this tool is not as precise or predictable as the open market operations are. Now, since small changes in the money multiplier can lead to large swings in the money supply, changing the required reserve requirement can cause the money supply to change by too much. So once again, this one isn't going to be as precise. So the main tool that they're going to use is going to be these open market operations. But let's look at that third tool of the Fed. This one is going to be the discount rate. Now recall that the discount rate is going to be that interest rate that's charged on loans from banks, well, loans to banks from the Fed. So the interest rate charged on loans to banks, so to those commercial banks from the Fed. Now these are going to be loans issued at interest rates well below the current market rate. So a commercial bank will borrow at a lower rate, say like a 2% from the Fed, and then lend it out to the general population, you and I, at a higher rate, maybe like 5 or 6%. Now the difference is going to be the bank's profits. Now when these loans are borrowed, or when these banks takes out these loans from the Fed, those loans come in as excess reserves. So if the Fed were to decrease, so the Fed decreases the discount rate. So if the Fed lowers the discount rate, this can signal to other banks to borrow in an attempt to loan out to the public to make some extra money. So if the Fed decreases the discount rate, that's going to lead to an increase in borrowing by banks. As I mentioned before, when they take out these loans, they come in as excess reserves. It goes straight to the excess reserves. So that leads to an increase in excess reserves. And we know that when excess reserves go up, that's going to lead to an increase in loans, which leads to an increase in the money supply. So with the discount rate, the other tool that they can use is to decrease the discount rate to increase the money supply. And then conversely, we'll see that the Fed can also increase the discount rate. As they increase the discount rate, that's going to lead to banks kind of being discouraged from borrowing. So that'll lead to a decrease in borrowing by banks. Which can lead to a reduction in excess reserves, which ultimately leads to a decrease in loans, which will cause the money supply to go down. So currently, the Fed discourages discount borrowing unless banks are absolutely struggling. So the Fed used this tool actively until like the Great Depression area. So additionally, it's not as precise because even with lower discount rates, banks can't be forced to take out these loans. And then also the actions can sometimes be misinterpreted as well. So these are the three tools of the Fed. They can use open market operations. They can use the discount rate. So we said increase the discount rate for contractionary monetary policy. Or they can use the required reserve ratio. Now, anytime we're looking at these, which looks at the expansionary, all of these lead to an increase. All of these actions lead to excess reserves going up. And then as we stated, anytime excess reserves go up, loans go up, which leads to the money supply increasing. All three of these actions, selling government securities, increasing the discount rate, or increasing the required reserve ratio, all of these lead to excess reserves going down. And as your excess reserves go down, loans go down, and the money supply decreases. Now, as I mentioned, the Fed will use expansionary monetary policy. So use when dealing with unemployment. So anytime we see that we have very high unemployment, we'll see that the Fed might employ some of these strategies to try to increase the money supply. Now, as we looked at in our chapter on GDP, we know that whenever there's an increase in total spending, then that can lead to an increase in output, an increase in employment. So that's what we want to do to try to counteract high unemployment. We want to try to make sure that we have increase in spending. So to do that, we'll try to get more money pumped into the economy. Now, of course, anytime you're pumping more money into the economy, you got to keep an eye out for inflation. So the Fed will keep an eye out, or an eye on, I should say, inflation when pumping a lot of money into the economy. So once again, high high unemployment can occur anytime we have like our GDP being below our potential. You know that you're in a recessionary phase. Now, with using some of these contractionary monetary policies, so selling government securities, increasing the discount rate, or increasing the required reserve, we said that all of those will lead to excess reserves going down, which causes loans to go down and ultimately the money supply to decrease. The Fed will use this or these tools used when dealing with inflation. Now, anytime you're employing a lot of contractionary monetary policy, you have to keep an eye out for unemployment. So keep an eye on unemployment when taking money out of the economy. So it's always a balancing act, trying to balance high unemployment, or low unemployment, and also low inflation. So hope this helps, and as always, if you watch the entire video, shoot me an email so you can make sure to get some extra credit points going towards exam number 4. Let me know if you have any questions.